Here on this slide, I want to show you the acceleration of technological change over time. On the x-axis, you can see the timeline from the 1750s to 2050, and on the y-axis, you see the rate of innovation. So if we start around the 1750s, we have the first industrial revolution starting and the first urbanization movement. So people were moving away from the land and agricultural work towards cities, and big cities were developing during this time. But this was a rather slow and linear process and went on for over 100 years. But then around 1870, 1880, there was the invention of electricity, the internal combustion engine, the assembly line invented by Henry Ford in the early 20th century, the railroad expansion, especially in the UK. And built on top of these technologies, you had logistics, aviation, with the Wright brothers being successful in their pursuits of flying, telecommunication, radio, TV. This was in the 1920s. And then jumping all the way to the 60s, 70s, 80s, the first PCs were invented. You have very clunky old school mobile phones in the 90s. Globalization was kicking in the 70s, 80s. A lot of research in genetics, and also the internet went online in the early 1990s. Going forward after the year 2000, we have online education, social networks with Facebook and LinkedIn and all of these other platforms, mobile data, so we can carry a supercomputer in our pockets. We have cloud computing to not store everything locally, but send it up to the cloud and store it there centrally. A race for space age and the green revolution with solar, wind, batteries, electric cars, and so a lot of new exciting technologies coming up there. And this is where we are standing at the moment with the Internet of Things, like to connect the physical world with the digital world, circular economy, that people are more environmental conscious and they think about how to reuse and recycle certain materials, robotics, autonomous cars, drones, 3D printing, nanotechnology, blockchain, artificial intelligence. And what you can see here when we look over the line and over the time, that the rate of technological change is accelerating, and this is what's called the rate of accelerate, or the law of accelerating returns, which means that every new technology is built on top of the shoulders of its predecessors. Because something has been already invented, you can use this invention to build on top of it and make it even better. And looking at speed, looking at efficiency, and also price to performance, all the things are developing in our favor. So speed is increasing, efficiency is increasing, price to performance is getting better, costs are declining. This leads to this explosion of innovation. And as you see, the curve gets steeper and steeper. And so we're in a really fascinating time these days. And there's so much innovation going on, and this makes it also very interesting from an investor's point of view. Exponential technology is covered in this course. Here in this slide, I want to show you the 6 technologies we are covering in this course and give you a brief overview about the content through the whole course. First of all, the definition of exponential technologies, they are called like this because they are on an exponential growth trajectory, and they grow way above average and way faster than other technologies in different fields. Let's start on the top left with climate tech. This is everything related to slow down climate change, to adapt to climate change. So solar energy, wind energy, battery technologies, electric vehicles, building, industrial tech, agricultural solutions, but also new system approaches like the circular economy. We speak about crypto and blockchain, how blockchain technology works, what kind of use cases we have there, what's Bitcoin, what's Ethereum, what other exciting use cases are out there, and what to be cautious of if you want to invest in blockchain and crypto. We speak about artificial intelligence, why it's so important, what subsets are existing, what use cases we have already today, what's expected to come in the future. We speak about gene editing, which is a very disruptive and exciting technology in my opinion, not very well known in the mainstream investors area. So this holds great return potentials if you pick the right companies. And we speak about digital platforms and why they are so powerful and why today's most successful companies are actually platforms, and what to consider here as an investor. And edge computing, which is a new computing paradigm additionally to cloud computing. And you learn about how it is, so how it works, why it is important, and what companies are active in the field and where you can invest in. So the goal of this module and the overall course is to give you a broad technical understanding of all of these technologies, but also let you know about interesting companies in the field so you can sustainably and financially benefit in the long run as an investor. So why now? Why do we have such an explosion of innovation, and why are some technologies jumping on this exponential growth curve and are growing so fast? As I already explained in the module of the acceleration of technological change, this is mainly due to the law of accelerating returns, that technologies are built on top of each other, but you have also developments when it comes to speed, efficiency, and price to performance, which are developing in the right direction for humanity. Here I display 3 examples of this. Starting on the top with computing cost performance from 1992 to 2020. So you see that back in the early 90s, you had to pay $222 for 1 million transistors. And this went down all the way to $0.06, so 6 cents per million transistors. So you see, this improvement is just fascinating in my opinion. And based on this cost decline, there are completely new possibilities evolving, and you could put more transistors on a microchip and therefore had more powerful computing power. And this process is still going on. It's called Moore's Law, and we're going to covering it in the next class, in the next lesson. Also looking at bandwidth cost performance from 1999 to 2020, you see from the 1990s, you had to pay around $1,200 per gigabit per second, which went down to just under $10. So here you also have a 100-fold improvement, and it's pretty cheap these days just to upload but also download data by the internet. And this, by the way, gave rise to streaming services like Netflix. Businesses like Netflix wouldn't have been possible in the 1990s or in the early 2000s, since the costs of streaming were just too high. Also looking at the storage cost performance, as you can see, in the early 1990s, you had to pay around $600 per gigabyte of storage. And nowadays it's nearly free. Like companies, for example, like Dropbox, are offering gigabits of free storage. Same for Google Drive. Just as a certain limit, you have to pay for it. So it's super cheap to store data. And this also plays a role when you think about social media or photo sharing platforms like Instagram, and the amount of pictures and videos they have to store in the data centers. And this is also just economically feasible because the costs for storage has declined so significantly over the last 30 years. So with this slide, I want to give you a general overview why we see this explosion of innovation. And the exciting thing is that the cost declines are expected to continue, which gives us even more possibilities for new products, new services, especially in the IT field going forward. So keep your eyes open how these cost curves are declining, and what companies could evolve and what companies could also be disruptive by these cost developments. Moore's law and Wright's law. What are they and how do they work? Starting with Moore's law, this is focusing on costs as a function of time. So it states that the numbers or the number of transistors per square inch of integrated circuits doubles about every 2 years. It's called Moore's law because the founder of Intel, Gordon Moore, was witnessing this, that about 18 months to 24 months, the number of transistors on an integrated circuit was doubling, and this consistently over a long time period. So what this means is that you can put more transistors on this integrated circuit, and therefore the computing power is also increasing. And you see it very nice on the graph on the left, that in the 1950s, when the computing revolution started, you had computing capabilities like calculations per second in the single digits or low double digits. But then this curve accelerated exponentially. And currently we are like in the gigahertz computing area. Like a regular desktop computer is calculating with about 2 to 4 gigahertz, which means 2 to 4 billion cycles per second. To give you a comparison, the fastest supercomputer, which is located in the US, it's called Summit, is calculating about 200,000 trillion calculations per second, which is about 100,000 times that powerful like a normal desktop computer. So incredible computing power. But as you see, on an accelerating curve and still keeping this pace and accelerating even more. Interestingly, when we think about quantum computing, the capabilities of computers are put to the next level, and we could see new possibilities which we never imagined before. Looking at Wright's law, this is forecasting costs as a function of units produced. Here on the left graph, you see crystalline silicium PV module costs and lithium-ion EV battery pack costs. When we look at the crystalline PV modules in 1976, you had to pay around $80 per watt. And this cost curve was declining heavily by the increasing amount of cumulative production. So the costs got cheaper and cheaper, and therefore the production of the units was accelerating and increasing. And the more you produce from a certain good, the cheaper it gets with the economies of scale. And this is based on Wright's law. And nowadays, if you look at the end of the graph with the crystalline silicium PV module, you are at about 3 cents per watt of solar PV, like from $80 in the 1970s to about 3 cents in the 2020s. And we see the same cost decline curve for lithium-ion EV battery packs. So like 10 to 15 years ago, you had to pay above $1,000 per kilowatt hour of storage capacity. But this is also sharply declining as the amount of produced battery packs is also accelerating. And nowadays, you pay about $120 to $150 per kilowatt hour. And both the solar PV module cost curve and the lithium-ion EV battery pack curve is expected to decrease further. And what researchers witnessed here with solar PV, you have about a cost decline of 24% by every cumulative doubling in production. And with battery packs, you have about 21% cost decline of every cumulative doubling. So these are very essential concepts to understand why information technology is moving so fast when you consider Moore's law, but also why certain technologies are jumping now on this exponential growth trajectory when you think about renewable energy like solar PV or battery storage. So what are the implications of exponentials? Here I want to share 6 pictures with you to illustrate the changes we very likely about to witness in the next years to come. On the top left, you see the transition from old fossil fuels like coal, gas and oil towards clean renewable sources like wind and solar energy. In the middle, we see the shift from paper-based physical money towards digital currencies, purely electronic, peer-to-peer cash systems like Bitcoin. On the top right, we see meat production facility, which will witness declining market shares when it comes to nutrition, because more and more people are shifting their diets towards a more vegan or vegetarian-based diet, and many companies are already active in the field of substituting meat with more healthy, but also in the mid to long run, cheaper alternatives to cow, pork or chicken. On the bottom left, you see Netflix, internet-based streaming service, which is more and more replacing traditional linear TV and cable channels. In the middle, self-driving cars. In this case, it's a Google car. And these self-driving cars will not just be steered by robots and algorithms, but also they will be electric and offer new services like mobility on demand, that urban car ownership is most likely to disappear in this decade, and people will just order a car to get from A to B like they are ordering a pizza from delivery services today. And in the bottom right, you see Alexa and other intelligent assistants which we have in our homes to help us and support us in daily tasks like checking the weather, looking at calendars, playing music, but also checking how traffic jam is evolving or giving us warnings if a weather warning is active. So these are just some examples how exponential technology is implicating our lives, and it's super exciting to live in these times. And also as an investor, there are amazing opportunities for you waiting out there.
In the following slides, I want to present to you some real-world examples of disruptive innovation within 3 different industry and technology areas. Starting here in the climate tech area with SolarEdge and Peabody. SolarEdge is a company out of Israel which is producing inverters for solar PV plants, but also now moving in the electric vehicle industry and also very strong in software engineering. Peabody, on the other hand, is a coal company out of the US and basically the largest coal producing company in the world. So if you look at their performance of the stock price over the last 5 years, you see that they are diverging quite heavily. While SolarEdge returned over 700% to its investors, Peabody was even losing in value with minus 17%. So this gives you a clear signal that the market is more bullish towards renewable clean energy than old school linear businesses like Peabody Energy. Let's continue with the next example. Here we have Tesla against General Motors. Tesla is a pure electric vehicle manufacturer against this old long-standing automotive industry, General Motors. While General Motors also is moving towards electric vehicles, over 90% or 95% of their car sales still happen with combustion engine cars. Tesla from the beginning focused on electric vehicles and especially on software engineering. So many people claim Tesla is more a software company than a car company. They make it quite smart because they also operate the charging infrastructure globally, and have really built a community, and there are big forums around Tesla, and they really have a strong brand ambassador community, which is not really the case for General Motors. And if you look at their stock performance over the last 5 years, also investors are more bullish towards Tesla compared with General Motors. Even if Tesla had quite a dip in 2022, it seems like they are recovering now, and the long-term outlook is quite positive for them. General Motors is more moving on a flat line, since it's a very old-fashioned business, linear thinking. They have a lot of shops and production lines around the world, which many experts claim is more like a liability than an asset, since it takes very, very long until they repurpose their production lines, and it comes with a lot of investment needed. So time will tell which company is the better investment. But if you look at the time period over the last 5 years, Tesla is the clear winner here. And the last example I want to present to you is Apple versus Nokia, so smartphone industry. So while Nokia, the Finnish company, was a leader in the 2000s and so on, around the beginning of the 2010s, Apple was growing exponentially since they introduced the smartphone, or the iPhone, and Nokia didn't take this trend serious. So if you look at the last 5 years of the stock performance, or the last 6 years in this case, you see that Nokia lost 20% of its value, while Apple was nearly five-folding in value. So this is not only the case because Apple has a more beautiful design, or has a better looking phone than Nokia does. It's also because Apple created a big community. They introduced the Apple iStore, Apple Music, and so on, and they enable people to develop apps and launch it on their platform. Furthermore, they have a unique design, and Apple most likely is the most successful brand in the world. So this should give you a glimpse that two companies within the same industry can have very different valuations and stock performance over a period of time, since one company is realizing exponential technologies and how to use them, and other companies stick to their old behavior, hierarchical, linear thinking, not thinking out of the box. And this is represented in the share price oftentimes. And the goal within this course is to make you aware of these trends and which companies are actually grasping these trends and growing faster than their incumbent competitors.
Exponential investing. So what do I mean by this kind of investment approach? So while traditional investors aim on incremental improvements and 10% gains in the short run, exponential investors aim for 10x improvements and 1,000% returns with a long-term time horizon. So what does this mean? So many people invest in companies who just slightly tweak their products and services, and they make them 2% better, 3% better. But it's no major breakthrough what they're working on. And therefore, the returns are quite moderate, and maybe 10%. And then these investors sell these stocks and these companies and hunt for the next incremental 10% gain. While exponential investors, they want to invest in companies which have like 10x better products and services and are real disruptors in certain industry, and therefore have the potential to deliver 1,000% returns or even more. Therefore, of course, being more risky, being more volatile. But there are a lot of examples in the past, just to name a few here: Google, Netflix, Salesforce, Tesla, and so on. These are all companies which in the beginning had seen some skepticism from mainstream investors, but people who realized their exponential growth trajectory early on, they achieved massive financial gains by investing early on in these companies. And this is what I mean by exponential investing: to really spot these companies early on, but then also have the grit to hold them long enough to achieve these 10x returns instead of just buying and selling within a couple of weeks or months. What I want to show you here is a formula which is quite an interesting concept for you to have a look at. Here IT, it's the starting value of an investment. CAGR is the compound annual growth rate. And T in this case is 10 years. So that means your initial starting value of the investment with a compound average growth rate of about 25% over a time period of 10 years equals about a 10x of your initial investment, which means you don't need to achieve these 1,000% returns within 1, 2, or 3 years. But if you have a long-term time horizon, let's say 7, 10, 12 years, then it's possible to achieve this. And again, as I said before, with Google and Tesla and all these other companies, they were in a so-called deceptive phase and they were growing pretty slowly, but then suddenly a major breakthrough was happening in their products or the services, and the stock took off, and all the early investors were rewarded quite handsomely. So this is an interesting concept for you to understand, that double-digit returns over a long time period are compounding and also lead to exponential wealth creation. So this is in a nutshell how exponential investors distinguish themselves from traditional investors. In this lesson, I want to speak with you about the investment opportunity of exponential technologies. Here I found a very interesting graph from ARK Invest, which is a pretty well-known investment company from the US. And here they show the estimated impact of innovation platforms on economic activity over time. So starting here around the 1800s, the invention of the steam engine by James Watt led to a lot of new economic activity, because people didn't need to use their pure muscle power anymore and could outsource this to the steam engine. A couple of decades later, the Brits put this steam engine on rails, invented the locomotive, and therefore the railway revolution was kicking in. Around the 1900s, we had this convergence of multiple technologies like the telephone, the automobile, and electricity, which triggered another wave of economic activity. So people could communicate over large distances. They could travel in very far distances, but also travel faster compared to their horse carriages. And electricity and the rollout of the transmission and distribution grid led to the construction of large factories, and also to the urbanization, because many people moved away from the countryside where they were active in agricultural activities. They moved towards urban areas and cities to work for these centralized factories. Yeah, then in the 30s and 40s with World War II, there was very little economic activity triggered by innovation platforms, but this kicked back in around the 1970s and 80s, when we had major breakthroughs with information technology. The first desktop PCs were available in the 80s, and then in the early 90s, when the World Wide Web was going online, we saw another wave of economic activity. So if we believe the analysts at ARK Invest, we're about to witness another amazing innovation revolution, and they defined 5 so-called innovation platforms, namely artificial intelligence, energy storage, robotics, genome sequencing, and blockchain technology. Here in this course, we're going to cover 4 of them, namely artificial intelligence, energy storage as part of our climate tech module, genome sequencing, which is a synonym for gene editing, and blockchain technology and crypto assets. So as you can see, it's very interesting that over history, about every 100 years, we witness these major breakthroughs and technological innovation around the 1800s, the 1900s, and now the 2000s. And I think it's an amazing time to be alive. And you as an investor, you have tremendous opportunities in the years to come. And the goal of this course is to equip you with the right skills, so you can spot these technological trends early on and then pick the right companies that you financially benefit from all of these developments as an investor. Let's speak about the difference between trading and investing. By definition, trading is frequently buying and selling assets with a short-term time horizon. So everything which is less than 1 quarter can be considered trading. So traders mainly focus on technical chart analysis, market volatility, and emotional trends. They read the news, they even do Twitter sentiment analytics and so on, and oftentimes don't really care about the fundamentals of certain companies they are trading. Investing, on the other hand, is buying and holding of assets with a long-term time horizon. So everything which goes above 1 quarter. Investors focus on fundamental analysis. They look at the financial statements like the income statement or the balance sheet. And they also check the macro environment where a company is active in. So they have a look at the sector, the industry. They think about how regulation could influence the valuation of certain companies. And they really have a long-term time horizon and also are very interested in compounding interest, which means compounding interest is the interest calculated on the initial principal you're owning with an asset. And over a very long time horizon, these can become really massive. So this, in a nutshell, is the difference between trading and investing. Here in this lesson, I want to speak with you about the valuation of Expotec assets. So for the companies and crypto assets we're going to look at, traditional metrics often are not applicable because there are no physical assets existing, or the companies are not yet profitable, or they haven't reached mainstream market maturity just yet. But there are some meaningful metrics we can have a look at, and some of them include the market cap of a certain company compared to the total addressable market. Also revenue growth, like how is the revenue developing on a quarterly basis, on an annual basis? How is a company valued in terms of their revenues? So price of a company in terms of market capitalization, of share price or a share price compared to the revenue they are generating. When we think about blockchain networks and crypto assets, we can have a look at developers. So are there more developers pouring into a certain project, or are they leaving? We can look at the hash rate. So how secure is a crypto network? These are so-called on-chain analytics. We're going to have a look at in detail later on. And one thing which I would like to share with you here, which is quite interesting, I think, is that most technologies experience boom and bust cycles before they reach market maturity. So if you think about internet technology, in the mid-1990s, it started that more and more .com companies were popping up, and the valuations back then have been crazy as well, around the 1999, 2000s. And then in 2000, in spring, the .com bubble burst, and the majority of these companies lost 95% of their valuations. But today's most profitable and most powerful companies emerged out of this .com crash. If you think about Google or Amazon or eBay, they were all part of this .com bubble crash, but are now highly profitable and powerful companies. Same is true for green energy. In the 2000s, there was a lot of hype and euphoria around green energy. But then in 2008, when the Great Recession hit, many investors put their capital away from these companies, and many went bankrupt. But now again, especially since the beginning of the 2020s, a lot of capital is flowing back into solar, wind, batteries, electric vehicle companies, and so on. And so they see a renaissance and a revival once again. Crypto assets, similar story. Since the inception of Bitcoin in 2009, there were multiple boom and bust cycles, and especially the year 2013, 17, and 2021, we saw huge declines in the valuation of Bitcoin and other crypto assets. But now it seems like they are reaching more and more market maturity, and the overall market capitalization of the crypto assets was constantly increasing. What I like to refer to here is that this was just a short introduction to valuation of Expotec assets, but we're going to do a deep dive in module 11, where we speak about tools, metrics, and ratios to apply. One very important concept for you to understand as an investor is diversification. So how can you hedge through diversification? That means how can you minimize your risks and optimize your returns by putting your eggs in different baskets or creating one basket with these different eggs, however you want to define it. So one important approach is to invest in assets from several different industries to reduce your overall risk profile. So basically, you should not just choose one industry, let's say software, and just invest in software companies, because therefore your overall risk is just too high if something is happening within this industry. Also, here are listed 3 tips for you how you can build a diversified portfolio. First of all, look at stocks across various industries or invest in an index fund if you don't want to do the research and pick single stocks. Next, you should find a balance of growth and value stocks. Because if you exclusively invest in growth stocks, you are subject to high volatility, and oftentimes these companies within the growth area haven't reached market maturity yet and are more prone to total loss of your investment. So try to find a good balance between young, fast-growing companies, but also more mature, well-established companies considered value stocks. And one important concept is also to look for none or inverse correlated assets. So if certain asset classes go up and the other ones go down, try to balance them out as well. So one example is that usually when stocks are rising, commodities like gold are staying constant or even decreasing, because rising stocks symbolize an optimism in the economy and people are betting on a good future. But when gold prices are rising, this is more indication for inflationary environment, or when the economy is weakening, people try to take away their capital from the stock market and put it in more secure assets like gold or silver. And this is also a very important concept for you to find a balance between stocks, commodities, and also like more risky assets like cryptocurrencies. But to sum up, diversification is highly dependent on your age, your risk appetite, and the financial goals you're having and the business cycles we're in. So these are kind of the most important concepts I would like to share with you here. And feel free to ask me questions or comment here if you have further questions about hedging through diversification. In this lesson, I want to present to you my personal Expotech portfolio and just briefly share my thoughts with you on this. So as you can see, I have between 20 and 25 assets in my portfolio, diversified in between the 6 Expotech areas we discussed earlier on. So we have gene editing, artificial intelligence, blockchain and crypto assets, digital platforms, edge computing, and also climate tech. So my biggest position here is Intellia Therapeutics, which is a leader in gene editing. And since I was investing in it pretty early on, it was growing to such a high position. But I'm very convinced about the company, and therefore I hold it, even if it's such a large position now. Second biggest position is Ethereum, since I'm a big believer in blockchain technology and the power of digital platforms. So Ethereum makes up about or more than 10% of my portfolio. NET stands for Cloudflare, a leading provider for internet security software and also a leader in edge computing and AI. Also kind of a new company, went public in 2019, and I also was investing in the company early on. That's why it got a relative big position in my portfolio. Also Bitcoin as my second biggest crypto asset in my portfolio besides Ethereum. I'm also pretty bullish on Bitcoin when it comes to its long-term perspectives. but I think there is even more potential with Ethereum, with all its smart contract capabilities, what we're going to discuss in detail in the blockchain module. Number 5, 6, 7 are Google, Tesla, and SolarEdge. And I won't go into detail with all of the assets I'm holding. But as you can see here, I tried to have a kind of balanced portfolio between all of the export tech companies. Here, Intelia is the largest by far when it comes to gene editing. And I'm kind of heavily skewed towards climate tech because I got a professional background in clean energy. And therefore, I think that it's super crucial to have a allocation towards climate tech companies, since this will just gain in importance in the years to come. And that's why I'm also pretty heavily invested in them. Yep, assets like Ethereum, Bitcoin, crypto assets are more risky, of course. But since I'm rather young, I want to take the risk, since the risk to reward potential is so incredibly attractive. And that's why I allocated nearly 1/5 of my portfolio to crypto assets. Here you have the description of all of the companies which are currently part of my portfolio. And one thing which I would like to mention in summary, that this is no financial advice, and you see this little disclaimer here, that this is only for educational purposes, and you have to do your own research before you come up with final decisions in what kind of companies you want to invest in. But if you continue learning as enthusiastically as you do in this course and in this module, I'm very confident that you will have the right skills to come up with the right decisions. Welcome to Module 5, Climate Tech. The overwhelming majority of scientists says that our climate is changing and human activity is responsible for that. If we want to avoid catastrophic climate events like the collapse of ecosystems, floods, droughts, hurricanes, famines or more, we need to get away from fossil fuels and radically change the way we grow and consume food. We live on a planet that's bathed in sun. Per day, 8,000 times the amount of energy is hitting the Earth's surface than what all of humanity consumes in 1 year. In 2015, nearly every country in the world committed to the Paris Agreement, which states that we have to limit global temperature increase by 2 degrees compared to pre-industrial levels. So there's hope, and amazing innovations are happening in the fields of energy, mobility, buildings or agriculture. Also, new economic system approaches like the circular economy are gaining more and more attention every day. In this module, you'll learn about the latest climate tech innovations, their socioeconomic impact, and how you can financially benefit from this global megatrend. Before we dive deep into climate tech, it's important to have an overview of the global CO2 emissions by sector. And this is a great chart I found, which is illustrating quite nicely how all of the CO2 emissions are distributed between different sectors. As you can see, by far the biggest part is emitted by the energy sector, mainly by burning fossil fuels like coal, oil, gas, and other greenhouse gases. Within the energy sector, you have this distribution between energy use in industry, transport, especially for individual transport and aviation, and the energy use in buildings like heating in residential buildings. The second big part is agriculture with nearly 20%. This goes both for raising cattle but also deforestation. So you have like the two major industries or sectors which are emitting the most CO2, which are the energy industry and the agricultural industry, and then smaller kind of hard to abate industries like waste management or cement and steel manufacturing. So this is very essential knowledge for you before we dig deep into the climate tech space, that you know, and you know how to address the different sectors and how important they are in the overall equation. And just to give you a glimpse, currently in the year 2022, the world is emitting around 51 billion tons of CO2 annually, and we are committed to reduce this amount to net zero by 2050. So a lot of work to do until the next 30 years. Here on this slide, I wanted to show you the different sectors we're going to look at in this module. And I distributed the climate tech landscape into 6 different sectors and areas. On the top left, energy. We're going to talk about solar and wind energy, batteries, and everything which is going on within the energy industry. Mobility, electric mobility, hydrogen, other forms of clean tech, climate tech mobility. Buildings, as we saw on the previous slide, that a huge chunk of CO2 emissions is associated with buildings, especially heating. So we're going to have a look at this area in detail as well. The circular economy, this is not a technology on its own, but more like a new systemic approach how to get into a more sustainable and just economic system. Industrial, since the industry is also consuming a lot of energy and emitting a lot of emissions, we're going to have a look at what kind of socioeconomic impacts we are witnessing there and what companies are active in the field. And last but not least, food and agriculture, which is, besides energy, one of the largest contributors to CO2 emissions, and what kind of new approaches are evolving in the food and agricultural space. And of course, look at value and growth stocks within the climate tech landscape. Socioeconomic implications within the energy space. So energy generation and storage tech are reaching so-called tipping points. Wind, solar, and other generation tech are now competitive with fossil fuels like gas and coal. They've been decreasing steadily over the last couple of years, which I'm going to show you in another graph following this section. And now in many countries and parts of the world, solar and wind energy is even cheaper than building new gas or coal power plants. As we can see, the overall energy demand is still rising on a global scale, and institutions like the International Energy Agency are projecting that the global energy demand is expected to increase by 50% until 2050. We are seeing exponential growth in renewables like solar and wind, which are going to disrupt fossil fuel-based incumbents. Because these fossil fuel-based companies, they are linear businesses and they are kind of hard to change from within. And the pace and speed like wind and solar energy is growing is going to have massive implications on their business models and basically make them obsolete in the next 2 to 3 decades. As I mentioned earlier on, we see plummeting costs for energy hardware as solar, wind, batteries, electric cars, and so on. And these will democratize the access to clean energy globally. Because in sub-Saharan Africa or parts of India, it's just not economically feasible, or it makes no sense to build new gas power plants instead of solar power. And the sunniest countries in the world are also the poorest one. So it's quite interesting to see this kind of democracy and justice around clean energy access, because these countries will benefit most from developments within renewable energy. Furthermore, this goes in the same hand that geopolitical tensions will be loosened with a higher degree of distributed local energy generation. Because if you look at the current distribution of fossil fuel resources, like 2/3 of all of these resources are in the so-called strategic ellipse, which is a region from the very north of Russia towards the Middle East and Saudi Arabia. And these countries, unfortunately, are politically quite unstable and have autocratic leaders, but the whole world is dependent on their resources. And with implementing more and more renewables like solar and wind, we can get more independent from these autocratic, non-democratic states, which are causing so much suffering for their own people, but also for other peoples by accelerating climate change with their fossil fuels. So if you look at the global primary energy consumption by source, you see that still like nearly 4/5 of the overall energy consumption is supplied by fossil fuels, gas, oil, and coal. Only around 16% is provided by renewable energy sources like solar, wind, hydropower, and I also included nuclear since it's non-CO2 emitting. And we need to like reverse this process and put it upside down, that we have 80% solar and not 80% fossils as we are having today. As you see on the graph, you have a decrease of traditional biomass, you have a decrease of coal, oil, and gas. And here, these small sections, renewable energies, are strongly growing, but kind of in a deceptive phase, like that comparably low compared to the others. But as I said, the growth rates are way higher than the ones of fossil fuels. This is the annual total CO2 emissions by world region. And here we also have a kind of an interesting picture, that nearly 60% of the CO2 emissions are coming from fast growing nations like China, India, and in general the Asia region. That doesn't mean that Europe or North America don't need to act on climate change. But the growth of CO2 emissions is coming from these countries, and it's especially our responsibility to help them meet this growth in a sustainable way and don't make the same mistakes like we did by meeting our energy hunger by coal or gas power plants. So this is also very important for you to learn here, that the majority of the energy demand is still met by fossil fuels, and the growth and increasing CO2 emissions are coming from the Asia-Pacific region. As I said, which needs to be kept, and therefore we need technology transfer and really a global collaboration to not let this escalate. On the next slide, I would show you like the price of solar PV module developed within the last decades and how the cumulative capacity changed. So here you have this typical Wright's law mechanism that you see in 1976. One solar PV module cost around $100. And this was all going down to nearly like 5 cents or 50 cents per module. And the cheaper they got over the time, the more cumulative installed capacity, of course, we had. What's very interesting to see here, if you look at the years 2007, 2008, this is when the last great recession hit. and many people pulled their capital away, or many institutions pulled their capital away from the stock markets or more speculative assets or more risky assets, let's call it like this, and invested heavily in renewable energies like solar. And this led to an even more dramatic decrease in the cost of electricity from solar PV modules. The same is true for wind costs. Here, similar picture. In the 80s, you had to pay 40 cents per kilowatt hour of electricity generated from wind. And this went down to, today even below 5 cents per kilowatt hours. And again, the cheaper the costs of generation get, the more cumulative wind capacity, or in this case, generation you have. A very simple but powerful mechanism I want to explain to you here is this circle. You have decreasing costs of a certain technology, and by decreasing costs you enter new markets because new companies, new people can afford these technologies, and the market is growing. So you have a rising demand, and with the rising demand you can produce more of this technology, and based on Wright's law, the more you produce, the cheaper the production gets, and this is like a self-fulfilling prophecy. And we saw this circle already in the smartphone production, in the desktop PC production, and now we're witnessing it again in the renewable energy space. So costs are decreasing, you enter new markets, the demand is rising, and costs are continuing to decrease. So this is a very simple but important concept for you to grasp. So last but not least, I want to show you the renewable energy generation around the world from the 1980s. So as you see, until the year 2000, the growth was kind of very, very slow and deceptive and not really recognizable. Hydropower has been on a linear, steady increase all over the world, but mainly with huge centralized power plants in Latin America, in China, and so on. And since the early 2000s, you see this curve for both solar and wind is bending, and also other renewable power sources like biomass are picking up speed. But especially wind and solar power are entering this exponential growth trajectory. And this is the same curve we witnessed with smartphone usage or desktop PCs. And I'm 100% certain that this is going to be the rocket industry within the next 20 years, because as I said in the beginning, we need to switch this amount from fossil fuel, 80% fossil fuels and 20% renewables, to 80% renewables and 20% fossil fuels. And so wind, solar and other renewables are poised for growth. And for you as an investor, it's a fantastic industry to play in. And I hope you got a lot of value out of this energy section I gave you here. What are the socioeconomic implications of the mobility revolution in climate tech? We can see accelerating EV sales and powerful platforms. Let me explain. Due to the declining costs of batteries and efficiency gains, we will see an exponential growth of the demand for electric vehicles. Bloomberg New Energy Finance is estimating that the amount of produced batteries, like the installed capacity, is about to 20-fold in the 2020s. So as we learned earlier on, due to Wright's law, the more production we see, the cheaper the cost get. And it's expected that by 2023, many electric vehicles will become cheaper than their gasoline-powered counterparts. So it's not just the environmental concerns or the following of some charismatic tech leaders, which will lead to a rising demand for electric vehicles. It's just a purely economic decision. And on top of this, also the performance of these vehicles, since they are not only going to be cheaper, but also more powerful and just more fun to drive with. What we will see is peak oil demand, which results in a shift from oil majors to focus more towards like petrochemical production. For many decades, society talked about peak oil in case of supply, that we're running out of oil. But actually, we will see a peak in demand for oil, or some experts claim we already saw it pre-COVID. And so the major demand for oil products won't come out of the transport sector in a couple of years, or I would say like in a decade from today. Furthermore, electric autonomous vehicles will eliminate the need for urban car ownership. So by the time you have on-demand mobility, which is cheaper than owning a car in a city, more and more people will get rid of their car, since it's like sitting idle more than 90% of the time, and is going to accelerate these ride on demand or mobility on demand solutions. And interestingly, this will be like a winner takes most dynamic, as we saw in information-based areas like e-commerce or search, like search engines. And I expect there will be very few companies which will consolidate within the overall mobility market, which are enabling both the physical car, like that you can own it, but also let it work for you, and also which provide the software to connect these physical assets and apply intelligence based on the software to come up with ride-hailing networks, for example. And currently, the companies which are in an advantage in these areas are data-driven companies. Like, just to name a few here is Tesla, obviously, but also new purely tech players which will come into the place, like Google or Apple. What are the socioeconomic implications within the building industry when it comes to climate tech? I titled it like this, that innovation, renovation, and regulation will likely disrupt the construction industry. If we look at energy within buildings, former energy consumers will become energy prosumers and enable grid supporting services. In the past, it was always like this, that you had centralized energy production, and the consumers within private and residential and industrial buildings were purely consuming the electricity, handing over the money to the energy utility. But this is being turned upside down, since we have on-site energy generation, either for electricity with solar PV or for heat with heat pumps. So you will have this interaction between producers and consumers, and there will be a mix of both, which you call prosumers. And these prosumers, they can be connected with each other and exchange and buy and sell electricity and surplus electricity between each other. And these are so-called energy communities, a new concept which has been implemented by the European Union. And interestingly, Austria is a front runner by implementing this so-called energy communities. In general, we can think about buildings will be converted to distributed power plants and data centers, because these buildings won't just consume electricity, they will also produce electricity. But besides electricity and electrons, they will also produce a lot of bits in the form of data and information. So you can apply super interesting models and ML, like machine learning approaches, by harvesting all of this wealth of data we're collecting from these buildings, and enable more efficiency when it comes to energy consumption, but also energy productions. As a result, conventional power utilities and oil and gas suppliers will see their market share shrinking, since the people will just need less electricity from them, since they produce more and more by their own. And the EU also decided to start the so-called renovation wave, which will also result in an employment boom in the construction industry, because it's a huge industry where there are millions of jobs, and there is so much work to do, because currently the renovation percentage per year is only about 1%. And the EU wants to double or triple this to 2 or 3% respectively. And therefore you need a lot of workers, a lot of skilled workers, which will lead to a job boom, which is especially important now after the COVID pandemic. Socioeconomic implications of the circular economy. Yeah, we see the dawn of a new economic system is on the horizon. And before we dive in, let's define what the circular economy actually is. The circular economy is an economy which consists of markets which give incentives to reuse products or use them more efficiently, instead of using them, scrapping them, disposing them, and then look for new resources to extract. So this is how a circular economy is defined. What we're seeing here is this so-called sharing economy, that people move away from ownership towards access. So especially these millennials and Gen Z, so people born 1980 and later, they are familiar with this sharing economy like Airbnb, like Uber, and so on. If we stick to the example of Uber, you can get from point A to point B just by using a mobile app without the necessity to actually owning a car. And therefore you save up money you can spend for other experiences like a holiday. Interestingly, we see these monopoly-like online platforms which enable the interaction between users and providers of these services. We're gonna dig deep later on in the module of digital platforms, but this is something for you to keep in mind, that despite we're having this sharing economy and circular economy approach, there are always like very powerful intermediaries which enable these transactions between the participants. We already see the rise of subscription-based businesses with centralized ownership and on-demand usage. Thinking about Netflix, where you pay $10, $11 per month, which owns all of the content. Spotify, the same subscription-based, which owns the content, or in the B2B world with CRM systems like Salesforce or HubSpot. Yeah, and uncertainties around commodity markets and regulation will accelerate the circular economy, because especially young people don't want to have the burden of a long-term commitment like a mortgage or an expensive house, because if oil prices are rising sharply, or if real estate prices are rising even more, and very few people can actually afford to buy houses, they rather rent them or move or use things on demand. And this is also fueling this circular economy / sharing economy. What are the socio-economic implications within the industrial sector when it comes to climate tech? I say there's a race for scalable, profitable, and transparent net zero solutions. And this space is offering incredible possibilities, and so many new players are getting in there now. What we're seeing is a rising demand for on-site energy generation and storage to increase the security of supply. So on the one hand, industrial companies like manufacturers or automotive companies, they also know that, for example, solar energy got very cheap recently. And so they install their own solar PV panels on their roof, produce their own electricity. But at the same time, they combine it with storage to either store the excess electricity if they don't use it, and at the same time increase the security of supply on site. Because with the rising amount of volatile renewable energies in the overall grid, the stability is also a bit worsened and gets more volatile, and the risk of outages is increasing. And for manufacturing businesses, it's essential to have a reliable energy supply. And that's why a lot of them are also investing in storage capabilities now. What we're also seeing is an increasing incentive for energy-intense industries to shift towards green hydrogen, because big energy consumers, they are part of these carbon trading systems and emission allowance systems. And for them, it's getting more and more expensive if they don't switch to greener sources to produce, for example, steel or cement. And here, hydrogen plays a very important role. And there has been an amazing project in Sweden already, where they produced steel by using green hydrogen. For shareholders in the future, it's also becoming more and more important that companies, especially publicly listed companies, are doing carbon accounting, and they represent it to their shareholders in a transparent way, so that investors know what's the current CO2 footprint. Is it rising? Is it decreasing? And so these kind of accounting and transparency requirements are going to increase as well. And also carbon trading and offsetting, what I was mentioning before. Some emissions are so-called hard to abate, especially in aviation or cement or steel production. And when companies are not able to fully substitute their CO2 emissions or put them to zero, there are other mechanisms in place, like buying carbon credits or compensate in different ways to reach net zero. Socioeconomic implications within the food and agricultural space. So, as we learned earlier on, the agricultural sector is accounting for nearly 20% of all global greenhouse gas emissions, and therefore it's a crucial sector to address in terms of climate tech. As I wrote here, the way we feed the world is going to change significantly in this decade, which means the way we grow food, we consume food, and we produce it also like in a biotechnological way is going to significantly change in the years to come. And this obviously is opening up a lot of opportunities for smart investors in the field and entrepreneurs, of course, as well. What we are seeing is an inverted correlation between industrialized and emerging countries in terms of meat consumption and deforestation. So while in North America, Europe, and so on, you have this trend towards vegetarianism, veganism, and the trees and the forests are actually expanding. In emerging countries, unfortunately, you see the opposite, like with rising wealth in Africa, in Latin America, and Asia, the meat consumption is increasing, and also deforestation is unfortunately increasing in these countries. Therefore, we need a strong action on alternative proteins and lab-grown meat alternatives and proteins from vegan, vegetarian, so-called superfoods, to being able to feed the rising billions in a sustainable way. Furthermore, we need efficiency gains, which are technologically driven, which means more automation in agriculture, more data analytics, as you will later see in the edge computing module. So we just need to drastically improve the way how we do agriculture and drastically reduce the amount of CO2 emissions this is associated with. Two high growth sectors are so-called vertical farming, where you see the picture on the left, where you stack plants and vegetables on top of each other, and you have artificial light and perfect conditions, which is less energy intensive and less water intensive than traditional agriculture. And gene modification companies, like we have a separate module for gene editing, but this is also a super interesting and very disruptive field, how we can use stem cells from plants and animals to reproduce them artificially in the lab and scale these new forms of foods all over the world. Let's look at the massive investment opportunity within the climate tech area. Here I illustrate the market cap by industry within the 6 regions of climate tech. There's energy, automotive, real estate, recycling, manufacturing, and agriculture. So if we quickly jump through them, energy, the whole energy industry is estimated to have a market cap at about $7 trillion at the moment. Automotive around 2.6 trillion, real estate 2.2. Recycling is the smallest of them with about 200 billion. Manufacturing 4.5 trillion, and agriculture of about $2 trillion. So if we accumulate all of them, we're gonna see that there's a total market capitalization of about $18.4 trillion, which makes the overall climate tech space one of the biggest industries overall on a global scale to invest in. So within this certain industry, as we learned in this module, you have multiple opportunities to either focus on energy, clean tech, mobility, buildings, manufacturing, industrial, improving industrial processes, agriculture with gene editing, with vertical farming, new recycling mechanisms. So the opportunities are endless, and all over the world, more and more capital is being deployed into the climate tech area. The biggest banks in the world actually are coming up with dedicated climate tech funds, and also the demand from investors is growing. And this is not just because of environmental or social concerns around climate change. It's purely because it's a fantastic economic opportunity, which we're going to witness here and see here over the next 20 to 30 years. So I really encourage you to look deep into this sector, go through this module again if you have still open questions, or reach out to me anytime. And in the next couple of lessons, we will go through the 6 sectors within climate tech I was explaining you in this module, and have a look at both value and growth stocks. Let's have a look at the selection of value and growth stocks within the 6 different sectors within climate tech. Let's start with energy. Looking at value and growth stocks, I listed 4 companies here. Let's start on the top with value stocks. Enel is the biggest energy utility in Italy and a major player in Latin America. Enel is one of the most innovative energy companies in Europe, and they are deeply committed to achieve the shift from fossil fuel-based electricity production to renewable production. And they invest heavily in solar, wind, and battery storage, and also have innovation lab called Enel X, where they think about new opportunities and business models. So this is a very interesting company from a value investor's point of view. Ørsted, former Dong Energy, is a Danish company, and they are heavily focusing on offshore wind energy. They are the market leader when it comes to planning and installing offshore wind turbines. And this is a rather small market still, but fast growing. So Ørsted is also a very interesting pick here. Looking at the growth stocks, There's SolarEdge. SolarEdge is a company out of Israel, and they have a very innovative inverter technology when it comes to solar PV. They have mini micro inverters and also diversify their product portfolio towards electric mobility. And they've seen tremendous growth already in the last years. But looking at their current market capitalization, there is still an enormous runway for them to get in the renewable energy market. Sunrun, American company, which is the leader when it comes to planning and installing solar PV power plants on private, residential and commercial buildings. And they offer innovative business concepts that their customers don't necessarily need to buy the modules and have a large capex or upfront investment, but rather have the opportunity to lease them, like pay a monthly kind of subscription rate, or get into a power purchase agreement with them. And they've also seen tremendous growth in the recent years. And especially in 2021, their stock was dropping quite heavily. So I think it's an interesting opportunity to enter again. Let's have a look at value and growth stocks within the mobility sector. So again, 4 companies divided in value and growth stocks, starting on the top with Volkswagen. Biggest German automotive manufacturer. Some investors might consider them pretty conservative and like a classical linear business, but Volkswagen is investing heavily in electric mobility, and they have the big benefit and advantage, in my opinion, that they have a global network of super powerful supply chains. They have shops, they have the physical infrastructure everywhere. And of course, they have the pocket money to diversify from combustion engines to electric vehicles. And their their models are getting more and more attractive. This year in 2022, the Volkswagen Bus is getting on the market. So an electrified version of the Bulli bus, which is like a retro car and a classic car. And I'm pretty bullish when it comes to Volkswagen. And I think they have quite an interesting and attractive role to play in the mobility market. Also, Google, this may come as a surprise to some of you, but Google is also heavily investing in autonomous driving. And they have an agreement with GM, General Motors, and a so-called affiliate called Waymo. And Google is without a doubt the leading company in the world when it comes to managing information. And they have all the other tools to become a successful mobility provider. When you think about Google Maps and all the behavior of the customers and just the amount of information they get. And they just need to apply it to the physical infrastructure, having an automotive partner and becoming even more powerful than they are already today. Looking at the growth stocks, Tesla, some of you might think Tesla is overvalued or shouldn't be put in the growth category, but I think it should. Because Tesla is not just an automotive company, it's also a AI and energy company. So they are offering electric mobility with their cars, but they at the same time offer storage, like batteries, stationary batteries. They have these solar roofs, so they will be active along the whole value chain, from producing your own electricity on your roof, storing it either on your stationary battery storage, or charging your car with it. And I'm 100% certain that they also want to connect these physical assets in the future and apply their trading software like Autobidder, which is already out there. So Tesla basically is going to become a global distributed energy utility, and in my opinion, the biggest in the world. So even if their market capitalization is about 500 billion at the moment, I consider Tesla to be a $2 to $3 trillion company. Aptiv is an Irish company, and they are one of the leading businesses when it comes to autonomous driving, developing software, security systems, also cybersecurity within electric cars. And their market capitalization is rather small, with I think at the moment like 50 billion US dollars. And this is without a doubt the future, electric autonomous mobility, and Aptiv is playing a crucial role there. Let's have a look at the value and growth stocks within the building sector. On top, we start with Vinci. This is a French company and is considered one of the largest developer and construction companies in the world. This is like a multinational conglomerate of more than 1,000 companies. They employ more than 100,000 people, are active in more than 100 countries, and deliver over 70,000 projects every year. They are mainly active in the areas of infrastructure like airports, streets, trains, and so on, but also large buildings. And as I said, are a deep value stock. They have an annual revenue of about $40 billion, and also have high commitments to environmental standards. And there's like a huge selection on their website where you can read up on ESG related things for Vinci. Another value stock I want to share with you here is Lennar. Lennar is an American home construction and real estate company. The sales are approximately 27 billion US dollars per year. So it's one of the biggest building companies in the US. And they include like smart home features, like with every new home, an Alexa is included where you can control the temperature within the building, or where you can start the heating, stop the heating. And they also take care of energy efficient appliances like dishwashers or dryers. So all of their energy appliances must fulfill highest energy standards. In the growth stock section, I included two companies. Skanska is a Swedish company. They are pretty old, so it's not a new company, but they have been active very long exclusively in Sweden, but then moved out to other countries within Scandinavia, and then now also active in Poland and in the Czech Republic, but also the US and Latin America. Skanska is considered the greenest construction company in the world, because they have very, very high standards when it comes to construction efficiencies, and these leader in environmental and energy efficiency standards. And they are front runner definitely when it comes to these sustainability issues in the construction area. In the UK, for example, which is another big market for them, they started the supply chain sustainability school to learn pupils and students what to take care of when it comes to building or purchasing a home. And so I think it's a very interesting company with very solid growth over the last years. And Century Communities is another American company. They are exclusively active in the US in 24 states, and they target single home and multi-tenant homes. Their sales are comparably low compared with the others, about $4 billion US dollars per year. But they have been the fastest growing construction company in the US over the last 3 years. And investors could have achieved great returns when realizing the potential of Century Communities early on. But since their annual revenues are still comparably small and they are fast growing, I definitely included them here in the growth stock area. And they have also very strong commitments to ESG, like environmental, social governance principles. For example, with every new home they are delivering, solar power plant on the roof is already included, or some other forms of renewable energy generation like heat pumps and so on. So quite a big picture from Vinci, which is by far the fastest or the biggest construction company in the world, to these new kind of rebels coming up like Century Communities. So yeah, a lot of opportunities for you as an expo investor, and I wish you good luck trading and investing these building and construction companies. Let's see what value and growth stocks are out there in the area of the circular economy. Starting on top with Airbnb, the major provider and intermediary between apartment owners and guests looking for a stay. They have more than 4 million listings on their platform and are still growing. But in my opinion, they have a pretty rich valuation with about $80 billion. So it's not a high growth company anymore, despite they're still growing. But I would put them in the value stock section, since I think they still get a very attractive runway and a very attractive future going forward. But the 5x, 6x, 7x gains are over. Pentair, Irish company, active in the area of water treatment, and also along the whole value chain with residential customers, commercial customers, industrial customers. They focus on different areas within water treatment, like pools, producing products for water treatment. And this is a crucial area within the 21st century in regarding the changes we are going to see because of climate change. So Pentair is a very interesting company to have a look at as well. Looking at the growth stocks, Tomra, Norwegian company, they're the market leader when it comes to recycling technologies and so-called reverse vending machines. So if you go to the supermarket or the store for drinks, you're probably aware of these machines where you can put in plastic bottles or glass bottles, so they are being recycled. And Tomra is the world leader in producing these machines, but also other technologies within mining, agriculture, and so on. And since the world, unfortunately, is flooded with plastic waste, and the majority of countries in the world don't even have recycling systems in place, Tomra is a super interesting company to have a look at, and also very valuable in case what they're doing and what they want to achieve. Suora, American company founded by a former Salesforce employee. They are focusing on the subscription economy, and their thesis is that more and more businesses are moving away from this linear thinking, one-time purchase business model into a subscription-based business model, that customers, as we explored earlier on, they don't want to just own things, buy them once and then throw them away, but rather get access to certain services like housing or mobility, music, and so on. And Tomra is developing a software system for companies to enable subscription business or subscription processes, and moving away from these one-time off payments, but having also a long-term relationship with their customer. And Suora got a pretty low market capitalization, and they are in the SaaS business, like software as a service, so very capital light. And I agree with the thesis that we're going to see more and more companies moving towards subscription-based business models. So this is also a quite interesting pick when you're willing to take more risk. Let's have a look at value and growth stocks within the industrial area when it comes to climate tech. Here again, value and growth stocks. Let's start on top with value. The first company I would like to share with you is NextEra Energy. NextEra Energy is the biggest energy utility in North America, and they call themselves the world's largest generator of renewable energy. They're mainly active in the area of solar power, wind power, and also now moving aggressively into energy storage, and have a portfolio size of about 46 gigawatt. But what do we have to mention here? From this 46 gigawatt, about 40% are still thermal power plants like gas. NextEra Energy has delivered above average returns to its investors over the last decade and is also paying an attractive dividend of about 2% annually. Brookfield Asset Management, a Canadian company, one of the largest asset managers in the world. They have about $150 billion under management, and they focus on so-called alternative assets, mainly in the areas of real estate, infrastructure, and renewable energy. So they operate in this intersection between buildings, how to supply them with clean electricity and clean heating as well. And they have revenues of about $80 billion US, so pretty big company. And interestingly, they also have a little venture arm called Brookfield Growth, where they also allocate some capital towards young, high growth companies, mainly active in the field of software and tech. So they can also have this intersection between these physical assets like real estate, solar and wind power plants, but also have equity, private equity in these new, young, fast-growing tech startups. Looking at growth stocks, here we have SunPower, American company, like a producer, seller, installer of solar modules. They are active along the whole value chain and target both private homeowners, residential customers, but more and more also like businesses and governmental institutions. As a little side note here, SunPower was delivering the solar modules for this solar impulse plane. Maybe you remember Bertrand Piccard, the Swiss pilot, flying around the world with a purely solar powered plane, and the modules came from SunPower. They currently have an annual revenue of about $1 billion, so comparably small, and with the growing demand and need for green energy and renewable energy, I think they have a pretty attractive runway and are interesting for growth investors. Bloom Energy is also an American company, and they offer a product called the Bloom Energy Server, which is a solid oxide fuel cell, and which is offering the possibility for their customers to get independent from the grid and have on-site energy generation. They currently have about 600 megawatts installed, and their customers are large buildings, industrial facilities, but also manufacturers or data centers, where it's critical to have a reliable, energy supply. And their customers especially are interested to have a backup system or be resilient when their connection to the main grid would fail or you have an outage. So yeah, quite a range of companies here. For the more conservative investors, NextEra and Brookfield, and for the more risk-taking but higher return hungry investors, SunPower and Bloom Energy. Let's have a look at value and growth stocks within the food and agricultural area. Starting on the top with the value stocks, Deere & Co, John Deere. This is a super old company. They actually have been founded in the year 1837, so nearly 200 years old. And they are the leading manufacturer of agricultural vehicles and machinery, forest machinery, and heavy equipment. Despite being such an old company, John Deere is quite innovative because they're doing heavy research on electric vehicles, even autonomous electric vehicles, and came up with new technologies like electric variable transmission system, EVT, where they connect multiple vehicles with each other with a direct connection to the grid, so they can be operated fully electrical. And if the electricity is produced from green sources as well, operate agricultural machinery in a carbon-free or low-carbon way. So despite being quite old, I think John Deere is a very innovative and also interesting company to have a look at as value investor. Second company, Nutrien. It's a Canadian company and they are the largest producer of potash and the third largest producer of nitrogen fertilizer worldwide. So it's a very crucial area they are operating into, even enabling food to grow all over the world. And the positive thing with Nutrien is that they have very strong sustainability commitments. For example, until the year 2030, they want to reduce their CO2 footprint by 30% compared to the year 2018. And they also have like many educational campaigns going on, and they invest in new technologies, both on the software but also on the hardware side, for example, to enable low carbon fertilizers. Yeah, continuing to the growth stocks, here we have Beyond Meat, American company founded 2009, went public 2019. They are offering meat substitutes like vegan alternatives to beef, pork, and chicken. And they are quite a hype company. Since they went public in 2019, their stock price rose from $40 in the beginning to over $200 in just a couple of weeks. And now, especially in the year 2021, they saw quite a dramatic sell-off and now are around $50 again. But we see this shift happening, especially in industrialized nations, that more and more people move away from real meat like beef, pork, chicken, and are looking for vegan alternatives. So I think Beyond Meat has a very interesting growth potential in the years to come. Same goes for United Natural Foods. This is the biggest wholesale distributor of organic foods in North America. And they are the main supplier of whole foods. And about 1/3 of their overall revenues are coming from whole foods. And as you might know, Amazon.com has a huge stake within Whole Foods. And so the more customers are becoming aware of organic and healthy foods and offering or buying them on Amazon, the more profitable and more the beneficial this is for United Natural Foods. And similar to Beyond Meat, what I mentioned before, more and more people are really becoming aware of healthy food, organic food. It plays a crucial role for them what they eat, and they are willing to pay more for healthy food. So I think United Natural Foods also has a very attractive growth trajectory in the near future.